how ready are you for retirement? Now, this is one question that many people fail to ask themselves, either because they feel they're too young to answer this question, or they feel that the government or the company they work for will cover it, just like we have the OAS and we have the CPP. If this is you, I assure you are in for an unpleasant surprise. So in this video, I'll be showing you signs that could indicate that you might not be ready for retirement and therefore could retire broke. And by the way, retiring broke at a time when you desire to enjoy your life could actually make an individual highly miserable. If you don't want that to be you, ensure to watch this video to the end and take the lessons from it.
I'll never be broke in my life.
As you already know, I've listed all the chapters I'll be discussing in this video just for easy navigation for you. So let's get into all the indicators I'll be discussing today. So number one is what I call retirement planning. If you don't have a clearly defined and documented retirement plan, there's an 85% chance that you would retire broke. And if you actually doubt me, here are some stats to prove what I'm saying. According to a research by Deloitte in 2023, 55% of near retiree households aged between 55 and 64 will have to make lifestyle compromises to avoid outliving their financial savings. Also, retirement savings growth has reduced significantly for many people, and this has affected overall retirement readiness and of course increased financial vulnerability. So retirement plan serves as a basis to estimate three major things. The first is when you plan to retire. So this is typically where you estimate your retirement age and how long you'll be relying on your retirement income. The second is how much funds you need to retire, and there are actually many schools of thought around this. One school of thought says that investment value at retirement should be 10 times your current annual income. Another one says retirement income should be at least 70% of your current income. Another perspective says that your retirement income should be equivalent to your current or targeted income plus a percentage buffer, all to cover your current existing living expenses. While another school of thought says that your investment value at retirement should be at least $1 million or $2 million target. The third estimate in your retirement plan is how long your funds should typically last. So this will depend on how long you expect to live after your retirement, how much your withdrawal of funds will be for debt payment, taking care of your family, your investment performance before and after your retirement, and the quality of health you anticipate to have after retirement. So here's a simple calculator you can use to estimate how much you need at the point of retirement. All you need to do is plug in the figures and it's going to tell you whether your estimates will be adequate or not. I'll also be dropping the link in the description for you to use to do your calculations. Number two is poor investment decisions. Now let me start by saying this. You cannot save your way into wealth. You actually need to invest to build wealth. Now that being said, I've seen a lot of people that make mistakes that jeopardizes their investment plan overall. Mistakes such as investing in products they don't understand, or stock picking when they don't have the knowledge to do this stock picking process, investing in high fee stocks, or not taking advantage of their employer match 401k or RRSP. So doing any of this could slow your pace towards achieving your retirement goal. Now for those that have no knowledge about stock picking, I'd recommend you go for low cost index stocks or funds like those that tracks the S&P 500, for instance the VOO. So the third indicator is what I call adaptability to hardship. So more than ever, many people are finding it really hard to adapt to the rising cost of living that we have today, including inflation. And this is largely due to significantly low income level, single income stream, households that are not saving enough to match the rising costs, lack of financial literacy or not getting the right financial advice, which results in knowledge gap. For instance, with the inflation we have today, retirement costs will be significantly higher than we expect it to be, which means that you'll need to save much more to be able to match up with the retirement cost in the future. Before I get into the next point, if you have found the information I'm sharing in this video very useful to you, please encourage me by liking and sharing this video so that I can continue to provide valuable content to you on an ongoing basis. So that brings me to number 4, which is investment related fees. If you don't pay attention to fees when you invest, then you need to listen to this very closely. So when you invest in mutual funds or exchange traded funds, you incur costs that is summed up into something called management expense ratio, otherwise known as MER. So MER is made up of management fee plus operating expenses and other administrative costs. So averagely the MER is about 2%, but when you invest in self-directed low-cost index funds, you could pay as low as 1% or even lesser. Let me show you how fees can negatively impact your wealth building journey or your retirement goals. So let's assume you invested in two funds, which is scenario 1 and scenario 2, where scenario 1 has MER of 2% and scenario 2 has MER of 1%. And of course, in both of them, you invested $150,000 and an investment return of 8% for both over 25 years. Ideally, your future value should be $1,027,000 based on no fees. However, you can see that the MER fee is about $383,000 if you had a 2% MER and $213,000 for a 1% MER, which means that you'll be retiring with about $643,000 versus an $814,000 just because of a 1% MER difference, which means that you would have saved $170,000 just by going for a 1% versus 2%. Another thing to note is that these fees are actually withdrawn directly from your account with no notification because it's already captured in your prospectus. So for every investment you do, ensure you read your prospectus properly to know the MER rate just for your investment needs. If you choose to do this calculation on your own, I'll be dropping the link to the MER calculator in the description. Number 5 is what I call the high interest debts. I would always recommend that you pay off all high interest debts such as credit card loans, personal loans, lines of credit before you start your investment if possible. So this is simply because the interest on debts would most times surpass the interest you will get on most investments, which will put you at a negative cash flow. For instance, if you are paying a credit card interest of 22% and you had an investment of just 9% returns, it means you are losing a whopping 13% on your cash flow basis. So my major rule of thumb is to ensure that you pay off as much as possible any debt that has interest above 7%. And of course, if you keep holding on to these things, it's going to impede your ability to build wealth quickly. So the 6th consideration is what I call neglected considerations at retirement. So when calculating your retirement funds, you should ensure to incorporate taxes, withdrawal rates, and even inflation that might occur at that time. For instance, if you're investing in your RRSP, at the point when you put the money into the account, it would not have been subjected to tax. In other words, you have literally postponed your tax time till the future. So whenever you're going to be withdrawing the funds, the tax will definitely be applied. So if you ignore it, then you have missed a key component of your estimation. So at the time of retirement, you need to take into consideration that the cost of living would have increased on an annual basis over the years. What you buy certain things today will not be what you'll be buying it at that time. In summary, if you have done all your calculations without considering all of these factors I've mentioned, there's a high chance you're going to outlive your retirement income, or your retirement income may not be able to sustain your standard of living, which will end up leaving you broke. As such, I'm going to recommend you perform a reassessment of your initial investment targets if you have not incorporated this, of course, or you meet a financial advisor that can guide you through this process. Anyways, I hope you found this video very useful and helpful to you. My desire is for you to be retirement ready as soon as possible, just to avoid any financial issues at the point of retirement in the future. So tell me in the comments, have you found it challenging to estimate what your retirement funds should be? Or do you have a fair idea of what your target retirement fund should be in the future? Finally, don't forget to like and share this video to anyone that will find it very helpful or useful to them. And most importantly, ensure to hit that subscribe button so you don't miss valuable content from me in the future. Thank you and have a good one.